Good morning, good afternoon to you, wherever you're joining us from. Welcome to the launch of Endeavor Nigeria's report on Africa's digital economy. My name is Tosin Faniro-Dada, and I lead the Endeavor Nigeria office. For those of you who don't know Endeavor, we are the leading global community of high-impact entrepreneurs. We define high-impact entrepreneurs as entrepreneurs who dream bigger, scale faster, and pay it forward. We truly believe that high-impact entrepreneurs transform economies, and we're on a mission to build thriving entrepreneurial ecosystems in emerging and underserved markets around the world. Today, we're in 40 markets. Last year, the Endeavor Nigeria office embarked on a project to lay out the case for investing in technology or internet-enabled businesses operating in Africa. We had a theory that there was a funding gap on the continent, where companies that have scalable business models, impressive traction, and great unit economics still struggle to raise growth capital. In writing this report, we reviewed key events in Africa's tech ecosystem from the last few years. We identified patterns, especially in the context of other tech ecosystems around the world, and we offered a roadmap to successfully navigate the opportunities that are emerging. Our report, which drew on multiple sources, including analysis from McKinsey Company, concludes that Africa's digital economy is approaching its S-curve, a period of rapid, significant growth that would positively impact the continent's GDP, job creation, and overall economic outlook. This report is part of a broader initiative aimed at facilitating access to frictionless capital for tech or internet-enabled companies on the continent. I would like to say a big thank you to the McKinsey team for going on this journey with us. Thank you, Topsy, for believing in the vision and helping us bring it to life, and for leading the McKinsey team. Thank you, Tola. Thank you, Mayowa, Ejiro, and Ikepo for working with us on this report. And to the Endeavor team, thank you, Derin, for conceiving the idea of this report. Thank you, Furo, Leye, Mide, and our two joys. And to our independent and PR consultants, thank you, Edema, and thank you, Bemi. To the countless number of investors, entrepreneurs, and operators that we interviewed for this report, thank you for your time, and thank you for your insights. I have probably read this report 6 or 7 times, and every time I read it, I am more proud of the work that we put in. I hope you find it useful in providing context about our digital ecosystem and the opportunity. And now, I would hand over to Tola Sunmonu-Balogun, an associate partner at McKinsey, to present the first half of the report on Africa's digital opportunity. Over to you, Tola.
Thank you so much, Tosin. Thank you for that introduction, and welcome to everyone. Thank you for joining us today. As Tosin mentioned, my name is Tola Sunmonu-Balogun, and I'm an associate partner at McKinsey, and I'm more than excited to take you through the first chapter of this exciting report that we put together. So I'll take you through chapter 1, and in chapter 1, we'll cover 3 key questions. One being, what is the size of the digital economy in Africa today? Number 2, what is driving that growth, and why do we think that growth is sustainable? And last but not least, what is the impact that we expect the digital economy to have on Africa as a whole? So starting with the first one, if we go to the next page, I think the good news, and this would be no surprise for those of you who've read the report, is we believe the digital economy in Africa is large, but also growing rapidly, and there's significant headroom driving that growth. So based on the work that we've done, we estimate that the size of the market is $115 billion and is expected to grow 6 times that to about $700 billion by 2050. And that headroom is quite apparent when you look at specific metrics, as you see on the left-hand side of this page, where it shows that the Africa digital landscape is improving, but there is significant opportunity when you compare where we are compared to world averages. As an example, if you look at individuals using the internet, you'll see that in Africa, that figure is 33%, which is almost half of what it is globally. Similarly, with active mobile broadband subscriptions, we see a lot of headroom there, and fixed broadband subscriptions, etc. So all in all, we believe the opportunity is big and growing. If you go to the next page, the other side of this is that we also believe that this opportunity is most concentrated in certain countries. And those countries are Nigeria, South Africa, Egypt, and Kenya. And that's largely due to macroeconomic metrics, as well as some digital economy factors as well. On the macro side, these are countries that contribute an astounding proportion of Africa's population, of our urbanization, as well as our GDP. And on the digital side, there's also a lot of digital activity happening in these countries. For instance, we see that 50% of Africa's professional developers are within these 4 markets alone. And these 4 markets alone also constitute over 70% of Africa's accelerators. So these are the areas where we see the most opportunity. If we go to the next page, what we also saw when we were doing this report is that we expect this growth to be driven by very strong underlying fundamentals, but also accelerated by 2 key things, one of which is COVID, and the other is the increasing supply of tech talent, although we know that there's still not enough tech talent on the continent, but there is an increasing supply, especially in the aftermath of COVID. So starting with these fundamentals, there are a few key pieces of data that I just wanted to highlight. Can we go to the next page? I think one of the underlying fundamentals that we believe is driving the growth in this market is the growth in consumer spend. In Africa, we expect consumer spend to be faster than we see in other regions. And you might be wondering how these predictions or how these projections fare in light of COVID, where we now see ourselves post-pandemic in a lot of countries where there's increasing inflation, increasing unemployment, etc. Despite these negatives, we still believe that there is a lot of opportunity for growth in consumer spend in Africa, albeit the shape might be a bit different in that people will likely be spending more on essentials versus increasing discretionary income as an example, or discretionary spend as an example. Next page. One of the other key fundamentals driving the market is the size, the growing size of the population, especially our youth. If harnessed, this can be a great opportunity for the digital economy for a number of reasons. Number one, we see that it is typically young people that are the fastest and earliest adopters of digital technology. But second, it also provides a pool of skilled and unskilled labor, including entrepreneurs, that help drive the growth and the development of the digital economy going forward. Next page. The third area in terms of underlying fundamentals is digital penetration. I'm sure a lot of you have heard in the context of Africa, we often refer to the fact that we're leapfrogging when it comes to use of digital technology. And these facts tend to prove that. So you see that across a number of these indicators, such as individuals using the internet, mobile cellular telephone subscriptions, international bandwidth, etc., the growth rate in Africa is faster than other regions. And in 2025, we expect to see quite significant growth along a number of these indicators. Number one, we expect that 1 in 6 of the world's internet users is expected to be in Africa by 2025. Secondly, 1 in 3 of all mobile subscribers globally will most likely be from the sub-Saharan African continent. And then lastly, the number of smartphone connections in the region is expected to double the current capacity. So these are all very exciting things that we see in terms of digital penetration, all of which, as mentioned, we believe is driving the digital economy. One area where we see this most pronounced is within payments. If you look at this chart, it shows very clearly that a lot of African countries, Kenya, Nigeria, South Africa, Egypt, are really in the early stages of their payments journey, which shows that there's significant headroom going forward. At the bottom left-hand side of this chart, you see that a lot of these African countries are clustered around the bottom in terms of low non-ATM card spend and low PC per capita. And as PC per capita grows, we expect this non-ATM card spend, which we're using as an indicator for electronic payments, to grow accordingly. And this growth in payments and in digital penetration in general has really been accelerated by COVID. So if you go to the next page, what you see on the left-hand side are the results of a survey that we ran. And it shows that individuals' use of digital technologies, such as online streaming, restaurant delivery, etc., has increased during COVID. What it doesn't show is that we also ran another survey, and it revealed that people expect these changes that they've experienced or these changes that they've adopted during COVID to stay post-pandemic. So these digital behaviors that people have picked up are expected to be sticky going forward, which again further supports the theory that COVID has accelerated and will continue to accelerate digitization. On the right-hand side, just as an illustration of that, if you look at the electronic payment transactions in Nigeria, you'll see that the post-COVID actuals significantly surpass the pre-COVID estimates. And that is because, again, a lot of this digital behavior was being picked up especially within payments. Last but not least, the real question is, why does this matter? What is the impact that we expect the digital economy to have on Africa going forward? And there are three key things. Number one, it improves economic well-being. Number two, it creates an avenue for new jobs. And number three, it leads to positive global recognition, which has a number of indirect effects. In terms of economic well-being, there's a lot of research and a lot of data that shows that GDP per capita is highly correlated with a number of these digital penetration metrics, such as mobile penetration, etc. In terms of new jobs, we estimate that due to a number of different improvements in the digital economy, we could create up to 44 million jobs on the continent, assuming internet penetration, for example, reaches 75%. And then last but not least, in terms of positive global recognition, the continued press and recognition that the digital space is receiving has definitely put Africa on the map amongst top global CEOs, companies, investors, etc., which again has a number of indirect effects that improve the ecosystem going forward. So that said, that is an overview of the context. And I'll hand over to my colleague now, Derin, who is the Access to Capital lead for Endeavor Global, who will take us through the remaining chapters.
Cool, thank you, Tola, for giving that overview. I have quite a number of slides, so I'm going to see how fast I can speak. Essentially, I'm going to be talking about three things. One is just the trend which we've seen in terms of the amount of capital flowing into the ecosystem over the past few years. Two is what exactly is that capital funding, right? What are the opportunities? And then three, I'll talk about, what can we take away from the report. And so I think the first trend we've seen is just how venture capital has become increasingly global. In 2021, 35% of funding went to markets outside of the United States. And in 2022, that number was 50%. And that trend has just continued to increase. In a similar way, in 2013, unicorn was still a rare word. Unicorns were rare, and we had only 4 ecosystems that had unicorns in them. And in 2020, we have 91 ecosystems, so 91 cities that have at least one unicorn. And that's just showing the increasing global reach of venture capital. Africa obviously hasn't been left out in this explosion of VC. As you can see on these charts, we have venture capital in Africa growing multiples over the past 5 years, and so growing from 270 million in 2015 to something like 5.2 billion last year. If we plot that on a graph with how the Southeast Asian and the Latin American ecosystems evolved, you would see a similar trajectory. Now, what we see is that I like to say ecosystems develop slowly and then all at once. And so you find capital start to flow into an ecosystem where it's, funding experiments, funding founders who are copying existing models, and, just generally trying to see if there's an opportunity there. And at the moment where there are a handful of proof points, you see capital rapidly accelerate. And so in Africa, we've had, sort of a slow and steady growth over, I'd say, the last 5 years. And then last year, we saw a real explosion of, capital flowing into the ecosystem, unicorns, large rounds, and all of that. And so we do think, even given this current moment in venture capital, that the African ecosystem is at the cusp of an explosion. If you look at the first quarter, or the first half of the year, the amount of capital that flowed into the ecosystem in Africa was, still significantly larger than last year, even as other ecosystems are starting to slow down. And I think a bit of that has to do with the fact that we're in a moment where the ecosystem is really taking off, even despite the headwinds that, venture capital is facing globally. Now, the second half of the year, I expect us to see, a little bit more of a slowdown just because we'll be affected by the same trends affecting, other regions. But given how early we are, I think there's still a long way for the ecosystem to grow. When I see headline funding numbers like, $5.2 billion raised by African startups, I like to dig a level deeper and say, where is that capital flowing? What stage is that capital flowing in? And, what types of companies? Because ultimately, if you think of a venture-backed company, and, in my role at Endeavor, I help entrepreneurs raise capital. And, most entrepreneurs raise 5 to 6 rounds over time, or at least 3 to 6 rounds over time at different stages, right? And so for an ecosystem to be fully developed, you need to have deep pools of capital across the entire funnel. And we're starting to see the funnel mature. Of course, the thesis of this report is that there are a few gaps where we still need more capital to flow, but we're definitely starting to see providers of capital focused on Africa, or at least active in Africa, across all the stages of a company's funding cycle. At the early stage, there's an interesting mix of local funds and then global accelerators. And so we have funds like Launch Africa, Keppel Africa, Future Africa, Lofty Inc., Flat Six Labs, all actively funding African entrepreneurs at the early stage. The way I like to say it is, if you have a great idea, if you're reasonably good at pitching, and if you're able to build the right networks and just hit the pavement and speak to a lot of people, you can probably raise a seed round for your company today. And that's very different from even 3-4 years ago. YC, of course, is a major player in the African ecosystem, taking sort of an outsized position. And I think they were one of the first global investors to really see the opportunity in Africa and double down on investing in the continent. Another trend that I think, when I think of trends that show the maturity of an ecosystem, another trend that's super important is dedicated pools of capital raised to invest in that ecosystem, right? It's nice to have, Sequoia do their first deal in Africa, or Andreessen do their first deal in Africa, but it's really important to have funds that raise, meaningful pools of capital to invest only on the continent, because that type of capital tends to be more sticky. And so when I look at, the past few years, we took out a couple of headlines of funds that, firms that have raised meaningful funds to raise in Africa. And so again, that's deepening the pool of capital available for African companies. And then, of course, this is just a slide of some of the global funds that have become, that have made their first investment in Africa or become more active. As I look at this list, and I see funds like General Catalyst, Dragonair, Rebates, Founders Fund, DST, all making their first or second investments in Africa over the last 1 or 2 years. It just shows, again, to the point of an ecosystem that is accelerating. It shows that the African tech ecosystem is at that inflection point. This is a chart that shows mega rounds and IPOs or acquisitions. Mega round roughly described as higher than 50 million. IPOs and acquisitions, only acquisitions where the acquisition amount was disclosed and where it was more than 50 million. And you can just see again that expansion and that explosion in the last 1, 2, 3 years. In a similar way, another chart showing the same thing, unicorns on the continent. Again, you can see that explosion or that expansion in 2021. in this chart, we use the very generous definition of African unicorn. So while people would argue, oh, is this company a unicorn because it operates in other markets, or is this company a unicorn because, I don't know, the headquarters was in San Francisco? We generally just focused on companies that were founded or largely operate in Africa. And you can see, that expansion of unicorns in 2021. Again, when we talk about mega rounds, unicorns, global funding, the point is not to build hype or, just like collect logos. The point is to show that the capital stack in the ecosystem is deepening, to show that if an entrepreneur has a great idea, there are funders that will fund you all the way from seed to growth and, potentially to exit. This again, is another chart showing the acceleration in the ecosystem, time to hitting $1 billion status. And we've gone from, InterSwitch and Fari, which are companies that were built in a very different environment, right? Where access to capital was very different, to companies like Chipper Cash, Swivel, Flutterwave, which were built, more recently and hit that $1 billion valuation pretty quickly. And then finally, just this chart talks about the gap that we see in the market. So you can see a very large drop off so the chart on the left shows deals by deal size. And so you have deals from 200K to 1 million, 1 million to 5 million. And then you see a big drop off with deals from 5 million to 10 million, 10 million to 20 million. And then, you see those larger deals of more than 50 million. Now, of course, you'd expect to see less deals of more than 50 million because, it's a funnel and companies drop off. Where I think the largest opportunity is that 5 to 10 million, 10 to 20 million range, that growth stage range, because that's the position. If you think of how investors look at an ecosystem, investors are very happy to put a small amount of capital into, a company that's just starting. So 200K, 1 million, 2 million, it's a nice idea. We'll put it, we'll see what happens. When a company is raising more than 50 million, then it's a spreadsheet exercise, right? You put the numbers into the spreadsheet. If the growth rate is fast enough, revenues are growing, margins are good enough, there's sites to cash flow, positive cash flow, even profitability. It's easy to put in a 50, 100, 200 million check into that type of company, regardless of the ecosystem, maybe slap on an Africa discount. But in the middle, where the check is a little bigger than, you can just give for an experiment, but has not yet hit all those proof points where it becomes a spreadsheet exercise, that is where we see a big gap. But that's also where we see an opportunity, because that's often where you can come in for a great company at a great price before it sort of accelerates and becomes obvious. And this again is the gap being shown in another way. You can see for Africa, there's an 84% drop off in terms of from seed stage to Series A stage deals, compared to 30 to 70% in other ecosystems. So again, while it's very heartwarming that at the seed stage we're seeing a lot more activity, we still think there's an opportunity at the Series A and some of those later stages. I'm just going to very quickly go through chapter 3. This talks about different sectors and the opportunity in different sectors. And I think the underlying framework here to understand is, as we looked across multiple sectors, we saw the same three or a very similar set of conditions that give rise to the opportunity. And so often we see high levels of fragmentation across multiple sectors, and I'll talk about that a little bit. We see high levels of informality, and then we see limited access for consumers. So I'll use payments as an example to talk through these three trends, but we see the same conditions in retail, in healthcare, in transportation, in education. Fragmentation in payments. So in the payment landscape in Africa, you have multiple different payment types, from card to bank transfers to cash, mobile money, PayPal, digital wallets, crypto. This is sort of a survey of digital platforms and the different payment methods they accept. And you can see there's just a wide range. Now, this wide range exists because multiple players have tried to displace cash. And so, people have innovated with cards, bank transfers, mobile money, etc. And this brings challenges for both consumers and merchants. So for the consumers, you visit a website and you're never entirely sure that your favorite payment method is accepted on that website. And for merchants, you need to integrate multiple payment methods to have, to make sure that regardless of what the consumer prefers, you offer that payment type. And that fragmentation sort of leads to higher costs for both merchants and consumers, but it also leads to an opportunity for people who are able to aggregate those multiple payment methods. The fragmentation also exists across different markets. And so if you look at the four markets we focus on, Nigeria, Kenya, South Africa, Egypt, you would find that in all those markets, there are different payment types that are accepted up to different levels. And so, Egypt is mobile wallet focused with like Fowry, but they also, have the major card schemes. Kenya is very mobile money focused. In Nigeria, we have very little mobile money, very card focused, very bank heavy. And in South Africa is very card focused. And what that means is if you're a company that's looking to operate across multiple African countries, they are integrating multiple payment types in each country. And again, that just increases the cost. But we also think that provides an opportunity for players that are looking to aggregate those multiple payment opportunities or those multiple payment types. Going to focus on mobile money for a second, because I think there's something really interesting happening in the mobile money space in Africa. If you look at the first generation of mobile money, where we had M-Pesa, Airtel Money, MTN Money, and Orange Money, that was built in an ecosystem that had certain characteristics. One is there wasn't a ton of venture capital. Two is internet penetration was really low. And three is smartphone penetration was really low. And so we had these telco-driven mobile money platforms that were built on top of, GSM infrastructure, and were built by telcos because they were the only ones that had the capital and the distribution to build them. Now we're seeing, fast forward about 10 years, we're seeing an ecosystem where there's enough venture capital available for other people to build out distribution. Smartphone penetration has gotten much higher. Smartphone penetration today is where mobile penetration was when M-Pesa launched, for example. And we have these fintechs that are building smartphone first, internet first, mobile payments, so not necessarily mobile money, but mobile payments platforms that are addressing the unbanked opportunity. And so I think that's a very interesting place for people to pay attention. Again, in Nigeria, over the past couple of weeks, MTN and Airtel have gotten their mobile money licenses. So we're going to see the telcos, Nigeria, which is a market where there's limited mobile money penetration, we're going to see the telcos competing against these sort of newer smartphone, internet venture-backed mobile payment platforms. Give me 1 second. And so that is a trend that's, sorry, I have a call coming in. So that's a trend that's interesting to watch. And then if you go to the commerce ecosystem, so if you go to the retail ecosystem, you'd see a similar trend again with informality, fragmentation, and a high cost to serve, creating an opportunity for people who are able to aggregate the many players in the space, formalize their operations, and serve the underserved players in the space. I'm going to go very quickly to the takeaways from the entire presentation. We go through 5 different sectors, talk about what has led to the opportunity, what trends entrepreneurs are facing, and how they're trying to address the opportunity in different sectors. And so you can go through that in, when you get the report after this presentation, sector by sector. But at the final section, what we do is we talk about a few takeaways for anyone who is looking to operate in the African ecosystem. The first takeaway is just to follow the money. And when we say follow the money, what we mean is that, if you look at the capital funnel from seed to Series A, Series B to growth stage rounds, you will find that there are certain gaps and there are certain areas that are underinvested. And those gaps are opportunities for people who can come in, plug those gaps and provide funds. Because what you find is venture capital is an ecosystem that rewards people who are non-consensus and right. And so if there's a space in the funnel that is currently underserved, then that is an opportunity for people who understand it. The second area the second takeaway is we talk about building local market intelligence. And a lot of what we tried to do in this report was actually give you some of the tools you need to build that intelligence. But the sense there is to explain that, the African ecosystem is really nuanced, really complex, and doesn't treat kindly people who, try to apply one size fits all style frameworks and style approaches to investing in the ecosystem. And so the second takeaway is, if you want to operate in the ecosystem, you need to build local market intelligence. The third takeaway, very similar to the second, is just, going back to first principles. There are lots of investment frameworks, valuation approaches, styles of investing in companies that may not necessarily transfer from other ecosystems into the African ecosystem. And so it's important that if you're operating there, you return to first principles. The fourth thing here is we talk about looking beyond the usual opportunities. I think when I speak with investors, I usually say, look, if you're operating on emerging markets, there's three types of companies you can find, right? You can find one that could have been a Silicon Valley company, but just happened to have been launched in an emerging market or in a market outside of Silicon Valley. Think of like Spotify or UiPath, right? Those are very easy to understand. There are also opportunities that are simply versions of a model you've seen in an advanced market, but just adapted for an emerging market. And so you can think of Uber for Nigeria or Brex for Kenya or what have you. And then you have opportunities that are emerging market natives that you wouldn't have seen in any other market. And there you think of businesses like Tencent or businesses like Gojek, right? Which could only have been built in the market they were built in. And often when you speak to investors, those are the businesses they find very hard to understand because they don't have existing mental models that can transfer. But those are often the places where you see the largest opportunity. And so this fourth takeaway is just telling people to, look beyond usual, look beyond familiar, look beyond just pattern matching when you're looking to invest in a market like Africa. The fifth takeaway here is just to, be very deliberate about mapping out exit pathways. Now, the African ecosystem is super nascent. We haven't had that many exits. Exit activity has sort of increased over the past few years, but it's still super nascent. And so if you're investing, you need to be intentional about saying, okay, what are the potential pathways open for this company? What do I need to get? What do I need to do to get the company ready for any of these pathways? What does the company need to look like to exit? I think on the bright side, we've seen the standard types of exits all, happen in Africa, one or two. We have, we had a local IPO with Fauri. We had Jumia do, an international listing. We've had a handful of acquisitions. We even had one SPAC. And so this fifth point isn't saying, one SPAC would swivel. This fifth point isn't saying exit opportunities don't exist, just that you have to be super intentional about, planning for those exits. And I think those are the five takeaways we have at the end of the report. Didn't go into detail on any of what we found in different sectors, just in the interest of time, and also to make sure you have something to read when you get the report later on. But I'll stop here and then I'll hand over to Tosin to introduce the panelists and take us to the to the third portion of the presentation of the event.
Thank you, Derin. Thank you, Tola. And now we're moving to our panel. And I'm just going to quickly introduce the panelists. Our first panelist is Yemi Lalude, who is a partner and head of Africa at TPG Growth. Yemi also leads TPG's growth investment in Africa. He's also an Endeavor Nigeria board member. Hi, Yemi. Our second panelist is Pardon Makumbe. He's the founder, managing partner at CRE Venture Capital. Our third panelist is Oviosu. He's founder and group CEO at Paga. Paga Group is a payment and financial services ecosystem for Africa. He's also an Endeavor entrepreneur. This panel will be moderated by Alan Taylor. Alan Taylor is the managing director of Endeavor Catalyst. Endeavor Catalyst is Endeavor's innovative co-investment fund that has been recognized as one of the most active global venture funds. Hi, Alan. Thank you for doing this. Over to you.
Of course. Thanks for having me. And Taya, Yemi, great to see you guys again. And Pardon, very
Great
nice
to see you.
And
Nice
work with
to
you
meet
for
you.
the first time. It's my real pleasure to be here. You know, as Tosin mentioned, I've been doing emerging market investing for almost 20 years, but we're super excited to see the progress of what's happening, specifically within these markets in Africa, Kenya, Egypt, South Africa, and in Nigeria. I've got some fun questions for you guys, and we're gonna let the audience also ask a few, but I'll start with just saying, you know, this is the first time we're releasing this report, you know, first time kind of seeing it. We got a sneak peek a couple days ago, but what's one or two things that really stood out for you? Tyler, you can go first. What did you kind of see here that you're like, wow, this, you know, I thought this was true, but now I can see it in the data, or what's something that you're going to want to share with other people from the report?
Yeah, no, thank you very much, Alan, and it's a real pleasure to be here with you all. I think this is amazing that this report, there's a lot to dig into. You know, one thing that, the many things that stood out for me that I've actually been sharing with my team, but one particular thing that just really became clear is that we are still at the beginning of the digital opportunity for Africa, right? If you look across the continent today, smartphone penetration is still about 20% in some countries, right? And so there's still a long way to go. And there's a $3.6 billion opportunity in sub-Saharan Africa digital payments, right? So I think that was really good, you know, big, you know, defining moment of like, you know, the future and the opportunity for us. And we're seeing it as well in our numbers post-COVID, and the scaling and the acceleration. This afternoon, I just tweeted out, you know, last year on our platform at Paga, and we're a company similar to Block, across Africa, we processed 35 million transactions worth 1.2 trillion naira. As of the end of May, we've already done 25 million transactions worth 1.2 trillion, right? And so we're seeing that acceleration, and it really started around COVID. And I think it's here to stay, and there's a long way to go.
That's awesome. Yemi, how about for you? What stood out from your reading of this report, the first of its kind that we're doing here?
Yeah, look, it's a fantastic report. So I was very glad to hear the Endeavor team decide that they were going to do the report, and I'm very happy to be able to participate in it. One of the things that struck me, I guess, was the so-called Series B gap, which Derin talked about. I mean, it's very stark, right? You can see how the numbers drop off. And yes, you would expect there to be a funnel, but you don't expect to have a cliff, right? It's a little bit different from a funnel. So that gap is real, and over time, for us to have an ecosystem that is sort of a sustainable one, we need to figure out a way to fix that. So that was really striking. It was also, to Tyre's point, it was really amazing to see the acceleration that COVID has really caused in digital payments. Again, at a company by company level, we see this, but just to see the huge jump in actuals versus expectations pre-COVID. I don't think that's something that is really well understood globally, frankly, and something we should all spend a bit of time communicating to the outside world.
Yeah, no, absolutely. Thanks for that. Pardon, I'll come to you. What's something that stood out for you from the report?
Yeah, thank you. I think actually two things that Derin said stood out to me. One was, he said to be a good venture investor, you need to be non-consensus and right, which is a difficult combination to get right.
Especially because you have to do it in that order.
Yeah,
exactly.
And then be right.
Right, and I think even more so because in venture, the strength of the pack is in the wolf, and the strength of the wolf is in the pack, right? You do need to work as an ecosystem, so that does make it really hard to be non-consensus and right. But and then the second thing that I think was pretty profound that Derin said was how you have these 3 or 4 archetypes of companies where you have companies that could have been just a Silicon Valley company. It just happens to be built in Nigeria or Egypt or Kenya. You have companies that are an X for an emerging market, an Uber for this country, and so forth. And then you have companies that are emerging market natives, right, which are much harder for the global community to wrap their heads around because they're just completely different mental frames, right? I thought that was pretty profound as well, because it does mean that for us as the investor community, we need to throw out a lot of our preconceptions about how things should or shouldn't work, and be willing to learn essentially from entrepreneurs on a first principles basis what could or could not make sense.
Yeah, no, makes sense. I should have mentioned at the start, the audience can definitely ask questions. I think that there's a Q&A or a chat function there, so please go ahead and type them out. We'll take a few of them towards the end. Yemi, coming to you for this next question, which is really this idea that, geographically speaking, the report talks about Africa, but it's pretty clear saying, hey, look, this is really, most of the activity here is in 4 places, right? It's in Nigeria, South Africa, Egypt, and Kenya. Do you agree with that? Does that kind of jive with what you see as a global kind of growth investor? And which of those to you is the biggest opportunity?
Yeah, it's certainly consistent with what we see, and at some level, not really surprising, right? Because those are 4 of the largest markets on the continent. Historically, have had a lot more activity on the tech side in terms of incubators and things of that nature that get the ecosystem going in the first place. So it's not surprising. The thing that is, and I don't know if disappointing is the right word, but the thing that is surprising at some level is that there's just not more activity in the Francophone markets. So that's something I've always tried to get my head around, to try to figure out why that is the case. Because you would expect, well, sure, they don't have the scale of a Nigeria or an Egypt, but you would think that Ivory Coast should be punching close to Kenya, for example, just to pick an example. But that's not the case.
Right.
It's very far, and it's not clear why that is the case. If somebody figures that out, maybe you can let me know. We've looked, and there's you just don't have the same level of entrepreneurial activity for whatever reason. So that's really striking. But it's not surprising that is the large 4 countries, and as we know from the U.S., the nature of the tech industries is one where you have a lot of value to being concentrated geographically, roughly, in a particular area. So Silicon Valley had that example, and then you have the cluster. So it's the so-called cluster effect that you have in tech investing. So you're never going to see this spread out across the continent. You're always going to have clusters. Now, the thing that I've found actually quite exciting is that people are starting companies in countries that I really would not have had on my 2nd tier or 3rd tier, countries like Malawi and Zambia and so forth, right? And these guys are getting money from international investors. So that's quite exciting to see, but certainly it's concentrated in the big 4.
I guess slight twist on the geography question for you, Tayo. As an entrepreneur and founder, obviously you guys started in Nigeria. I think you see opportunity across the continent, potentially across the world. What are some of the markets you're excited about the growth of, maybe for your own business, but even for the sector?
Yeah, I mean, if you look at what we do, Nigeria itself is a big enough market that one could argue we could just stay in Nigeria. There's a lot to do here. And there are examples of that. If you look at Paytm has not left India, right? But I think the big difference is that the macro of Nigeria actually lends itself to the point that you should diversify, right? And that you should look at other markets. And so across Africa, the reality is that payments are still at the early days in a lot of markets, and not just the mobile money wallet business, but other spectrums of payments. So for us, we're very excited about some of the usual suspects like Kenya, Ghana. We're looking at But we are launching Ethiopia. That's one that we have declared, and we're now moving forward with a bank partner there to launch that market. But the way we think about it fundamentally is that across many markets, the things that we offer that we'll be able to offer in multiple currencies across different markets. And then it's and where are those places, and how do you build out, and what do you solve, and what do you go after? So yes, I think there is, to Yemi's point about the Francophone, Yemi, it's actually interesting that it's one, there are a couple of the Francophone countries people keep saying you should go take a look at, like there's just, but I think maybe there's a barrier because you don't speak French. I think, how do I engage with this? But actually maybe it is something that we should actually take more closer look at, right?
Mm-hmm. Pardon, which markets are you most excited about as a venture investor?
Yeah, I think in some ways it's the usual suspects, right? I think Nigeria wins just on the sheer scale of it. And if you ever walk down the street in Lagos, you get it, right? The energy and the buzz and kind of the restlessness is an entrepreneur's dream, is an investor's dream. I think I'm intrigued.
That's the part we miss on Zoom, to be honest.
True.
It's hard to get here.
Well, if you listen very carefully, you may hear a generator buzzing in the background. But if you go to, I think South Africa is really interesting. I think South Africa, in some ways, it's a big structurally significant economy in the region. Somehow, it has not really energized the venture community in the way that the Kenyas and even the Ghanas of the world have, which in my mind is a little confusing because I think there is actually more scale in that country. And there's also a longer legacy of venture-like investing and tech-like entrepreneurship, going all the way back to the legendary, I think it was Mark Shuttleworth, right, who built Thought that he sold for like $500 million in 1997, right? Most of us were not born. Actually, I was born then, but the point is, I think I'm intrigued by what South Africa can be, somewhat trying to figure out why that hasn't really bloomed and blossomed. I think Egypt is very interesting, again, for its sheer scale and 90% of the population being around the Nile. That density creates clusters that you can do a lot with. Ethiopia is a labor of love. At least a couple of people on my team are Ethiopian, and we are very intrigued by, again, the scale of the company, also of the country, but somehow it's not really been as open for business as we would hope. And we think that if and when that changes, that could become like a very, very important economy because there's a lot of some of the same needs that you have a day one need type situation. But again, we need to unlock it. So I guess I'm mostly intrigued, in keeping with Derin's point, in trying to be non-consensus. I don't know if I'm right, but I think South Africa is very interesting for that reason. Ethiopia is very interesting for that reason, and Egypt as well. Yeah.
Awesome. I'm going to shift this just a little bit and talk about sectors and business models. And I'll share a framework that we have at Endeavor, for the context for the audience. We invest across emerging markets with our fund. Endeavor supports entrepreneurs, as Tosin mentioned, in more than 40 different countries. And looking at the data over the last 25 years in Latin America, in Asia, in the Middle East, and Africa, we do see some very rough trends in terms of the types of businesses that get built. And what got talked about here today in the report are what I kind of call wave one and wave kind of 1A, right? Which is wave one is always consumer. And Tola kind of emphasized that in the beginning, and you can see in a lot of logos, a lot of the consumer tech, commerce type businesses being built. And wave 1A that kind of goes with it is the payments rails, all the different payment systems, and the logistics, or call it the digital infrastructure, kind of it needs to support that consumer wave.
Yeah.
What's interesting is that in different geographies, that wave can last a very long time before you start to get businesses in education, ed tech or health tech or agri tech or even B2B, right? In our experience, it's almost like three big waves. The first one is the consumer and all the digital infrastructure. The second is tech disrupting all these big industries. And then the third kind of is more enterprise, SaaS, B2B, which in some ways ends up being the biggest one because the digitization of the SME economy is such a big thing when it starts to happen, as is happening today in India and Brazil and some other places. I guess, Yemi, I'll come to you first. My question is, if we were to write this report in 3 more years, do you think we'll see continued funding into that kind of first consumer and digital infrastructure wave, or are we going to start to see more funding and more company building in those next waves?
Interesting, and the framework you have certainly makes a lot of sense. But I think we're starting to see it already.
Yeah.
Because there's the B2C and the reality is the nature of a B2C business is such that you're out there, you're doing a lot of marketing, people talk about you. In some ways, it's more sexy. So there's a lot of noise about B2C companies. But there's a lot of funding going actually into B2B companies now, right? Because as we know, after fintech, the second subsector that people are putting money in is the new age B2B e-commerce businesses, right? That's all B2B. And in Africa, the B2B is in many cases sort of B2 SME is really what it is. And like you rightly said, there's a huge volume of SMEs on the continent. And the companies like Yoko going after that, obviously the B2B commerce players, they have big companies on one side and have SMEs on the other side. So I think we're actually starting to see it. And if we go back sort of to the beginning of the tech ecosystem in Africa to interest rates as a B2B business. Anyway, so it started with B2B anyway. But it's just that B2C ones they make a lot of noise, they're advertising, you see their billboards, and it just seems like all the money is going into B2C, which B2C maybe still edges out B2B, but I don't think it's as much a difference as people would think, just sort of on the perception. Yeah.
Interesting. Ty, what's your take?
Yeah, no, Yemi's right. We're already seeing it happen. And in my case, we're seeing it in our business. We're also seeing it because we enable other businesses, right? So we launched our B2B, or really doubled down on our B2B side of our business last year. And that where we provide a platform as a service to other business to put in fintech building blocks into their solutions. And that is growing TPV at about 3,000% plus, right? And these are big numbers. Did 95 billion last month. So and that is because it's enabling others who are businesses to drive their thing. And we're seeing it in the investment landscape. We're seeing people already. I think the only difference is that the B on the other side that is being addressed now is actually relatively a smaller B. So it's a small, medium business, whether it's the restaurant owner, the supermarket, it's that kind of B. It's not yet the enterprise grade. And I think that wave will still come. Yeah.
So this is Yemi called it B2 SME, which starts to get a little alphabet soupy, but
That's right.
That's what it is.
Yeah.
Pardon, I guess, coming to you, which particular sectors, or I'll say business models, sort of stand out to you and maybe the pitches you've seen in the last couple of months from entrepreneurs?
Yeah, I think at CRE, we pride ourselves in our ignorance, right? We don't claim to know where the future is headed or what businesses will do or not do well. I think we mostly look to talk to as many people as possible and learn what people are building. We think the things that I like to say, just when the right thing to be doing in the world was, just when common knowledge would say, you should be investing in the next Sun Microsystems, you should actually have been looking for Google. When it was, hey, invest in a search engine, you actually should have been looking for social media, right? And when it was social media and so forth and so forth. So I think we definitely see a lot of different patterns to some of the points that have been made here. B2B commerce, marketplaces has been a trend, payments businesses have been a trend, but I think inherently we don't really have a theory as to where the world should go, but we try to be avid students of where the world is going just by talking to people and doing a lot of work to understand what the different business models are.
We've got a couple of questions trickling in from the audience. One of them is about crowdfunding as a source of capital for entrepreneurs. I'll address it actually in this way. I'll ask you guys a slightly bigger question, which is, we're doing this in early June 2022. We are in a dramatically different funding environment globally for private companies than we were 6 months ago. And there's a lot in the Twitter sphere and a lot online, a lot you can read and listen to about that. But the question I have here is more thinking about entrepreneurs. So Tayo, your peers and colleagues, or Yemi, your portfolio companies or future portfolio companies. What advice are you hearing? What advice are you giving these days on sources of capital to fund your business? Right, and you can put crowdfunding as one possibility. Debt is a possibility. Inside equity from your existing investors, outside equity from the market. Nobody has a crystal ball on the future, but how do you help entrepreneurs, Yemi, think about, their choices of how to fund their company over the next 6, 12, 18, 24 months?
Yeah, I'm certainly not suggesting to anybody that they should go try crowdfunding, for the very simple reason that crowdfunding is what you call an upcycle phenomenon. In other words, when the economy is doing well and everybody's feeling flush, crowdfunding works. When you really need money, you're not going to get any crowdfunding done. People are saying, I'm going to be putting money into startups. So a lot has been said about this, right? Several of the VC firms have put out presentations to their portfolio companies and so forth. So I'm sure everybody's quite familiar. But at the end of the day, there are a few things, I guess, that I would add to the general discourse on this. One is that the valuations aren't coming back anytime soon. It's done. It's like you went to a party, you drank too much, you have a hangover, and it's just never going to be the same again. All right, so they're not coming back. So if you think you're going to wait 3 months and the valuations will be like June of last year, ain't going to happen. And I'll bet any amount of money with somebody on that, right? So this is what a correction looks like, right? This is the new normal. And it takes like 5 years to make it back. You can look at it historically. So this is the new normal. Therefore, I think it's quite important for everybody to keep that in mind. If you need to raise money, you just have to be practical about it. Facebook did a down round. I mean, many people don't know this. Facebook did a down round because it was a bad environment and they had to raise money to continue to build the company. So the rest is history. So it's very important to be pragmatic on these things. I know it takes a while, and just at a basic human level, that adjustment takes a while, but the correction has happened. Things are going to change. So the question is trying to figure out how you get the funding with the right partners to be able to achieve the goals you have for your business, which is, thinking about all the things you could have bought with the money you thought you had, which you actually don't really have because it's all on paper. So there's that. And then I guess there's obvious things about being prudent with your spend. But I would say don't mortgage your future just because, and this is the mistake I think people sometimes make, because you're hoping that the market is going to go back to where it was, and all you have to do is just get some extra runway and it'll be back there. You're optimizing for the short term, which actually impacts your long term, right? So don't forget the prize at the end of the day, what you're trying to build with your business, and optimize for the long term. There might be some short term pain on valuations, but I wouldn't now just cut my spend and stop growing just so I can wait 6 months for valuations to come back. And some people actually do things like that, right? So that I don't think that's very prudent.
Yeah, good advice. Tayo, what's the best advice you're hearing or sharing with entrepreneurs?
Let me let Pardon, my boss, go for it. Yeah.
Well, thanks for throwing me under the bus, Tayo. So I think there's a couple of points to highlight, right? I think there's a distinction between valuation per se and just capital markets, the availability of capital, right? I do think, to the point that the report made, there's a fair amount of capital formation that's been happening that's focused on the region. And I do, I may be naive or optimistic, but I don't think capital has dried up categorically. I think investors are biding their time to see where things level out and then sort of determine how they move forward. To Yemi's point, I don't think you get the euphoric valuations of 12 months ago, but I do think there will be some capital flowing. But I like to say, if you're an operator or an entrepreneur, you really have two sources of capital, customers and investors. The best place to raise money from is from your customers, which is, build products that people are willing to pay for. And build services or products that are counter-cyclical, that will not sort of break when the economy slows down, but that people will continue to consume, probably because you're building structural solutions, right? Probably because you're building things that people cannot really live without once they have discovered it, right? I think the work that Taya is doing and some of the numbers is shared attest to the fact that what is building is not beholden to an economic cycle, right? And at the end of the day, I think the best source to raise capital from is, build great products for your customers. But if not that, then obviously there is venture, there's revenue-based financing, there's venture debt and so forth. But a lot of that, how it's underwritten, still goes back to the fundamentals of, are you running a good business? Are you raising money from your customers? Which gets us back to the way we started. Yeah.
Right. Yeah, I find in this particular information cycle we're in, right, where every week some venture firm releases a new 50-slide presentation on how the world has changed and the sky is falling. It's all helpful and it's all real, but it does make me think about this quote that, human beings, and particularly those of us who work in the innovation economy, entrepreneurs, investors, et cetera, we tend to way overestimate what we can do in a year, but we tend to really underestimate what we can do in a decade. And that quote gets to Bill Gates and lots of other people smarter than me. But I love the concept, right? Because we live so much in the here and the now and in this moment. Yeah. And parts of this report actually, by projecting out, well, here's what 2025 could look like, or 2030 or 2050, right? Help us think about, we're doing a really long-term thing here, right? In trying to bring about digital transformation to these economies. And so, I think we're actually out of time, but I wanted to take a minute just to thank you guys for coming on, for being a part of this, and for helping Nigeria and McKinsey and all the partners get this report launched, because it's an important piece of work. My last question for everybody is, who should read this? Who do you recommend to go out and read this report once we start sharing it? What do you think?
Obviously, everybody should read it. Anybody.
I want to send this to everyone in Silicon Valley. Every investor in Silicon Valley. Right?
I want to send it to every regulator in Africa, starting with CBN and others. Yeah.
Yeah.
Well, you guys are in charge of that. I'll help with the Silicon Valley people. Yeah, I don't know the African regulators, so you're gonna need somebody else.
Awesome.
Anyway, maybe I'll look for guidance from Tosin or anyone else who wants to come on. I know the report will be shared officially at some point later in the day. I'll give Tosin the final. But Yemi, Pard, and Tayo, thank you so much for being a part of this.
Thanks, Alan.
Thank you very much.
Thanks, Alan.
Good to see you.
Thanks.
Yeah.
Thanks, guys.
Thanks, Alan. Thank you so much, guys. And thank you so much to everyone for joining us and staying with us past the time. You would all get the report by the end of today. I'm happy to answer any questions. Please shoot us emails with questions if you have any. But thank you for joining us. And thank you to our panelists. Thank you, Tola. Thank you, Derin. And thanks, Alan. Bye, guys.
Thanks, everyone.